What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast, and I'd like to thank everybody listening onto Podcasting 2.0 apps such as Fountain and Streaming Me Sats and doing all that kind of stuff. But wherever you get podcasts, feel free to subscribe. Also, look forward for my YouTube because I'm putting up a lot more clips and everything like that. So just go ahead and search Green Candle on YouTube there. But I've got a very special guest. If you've been on the Tuesday night spaces recently, I'm sure you've heard him. We got Jim here. Jim, how are we doing today?
I'm doing just great, Green Candle. Thank you very much.
Yeah, so Jim, I kind of refer to you as my futures and kind of precious metals guy these days. So why don't you tell us a little bit about your background and kind of how you got to where you're at today?
I responded to a postcard in the mail that I received. I'm from the Twin Cities, which is St. Paul, Minnesota. And the postcard was from a futures broker that later became a friend of mine. And it was basically the type of postcard that I wouldn't have been used to, or I wouldn't have thought that it made any sense. But basically what it was a postcard to offer a lifelong, if it would work, a lifelong income stream from a set amount of money, analogous to maybe like an annuity or something like that. So I responded to the postcard. I went and I met the gentleman, and I thought that this could be an interesting business. I was in my probably mid to late 20s, I would say, at the time. And I traded for a little while, and then I figured I really liked buying and selling. So I took the class for licensure and became a broker in 1986. I was in an office in the Minneapolis Grain Exchange that was well experienced with professional brokers that had been brokers a long time, along with a friend of mine that I had responded to his postcard. He then moved to San Francisco to manage another office in San Francisco with a colleague of his. And so I decided to join the office in Minneapolis where he had been trading. And I started there in, I believe it was June of 1986. So I learned about the different months, learned about delivery, learned a lot about grains and livestock. And one or two of the guys were metals guys. And I really learned a lot about metals from them. One friend of mine in particular sat behind me two rows behind me. He taught me options, both buying and selling options. And I learned well. And I have turned that lesson from my friend Rob into a decades-long ability to do covered call strategies, covered put strategies, or short strangle strategies. Basically, buying a futures and selling an out of the money call, selling a futures and selling a below the money put, below the market put, or selling an out of the money call and an out of the money put at the same time. That's short strangle. And it's been really good for a long time. And I've been active on Twitter for several years. And my ability to answer questions, explain, give examples, that kind of thing has, I think, helped many people understand a little bit about futures, Brandon. And the other thing is that there's a bunch of people on Twitter, too many people on Twitter, that think they really know what they're talking about, and they spread a lot of misaccurate information. And I'm trying my best to correct some of that as well. So that's kind of how I moved to from the Twin Cities, Minneapolis, St. Paul, to the Tri-Cities of Florida. They don't call it that, but Tampa, Clearwater, St. Petersburg, after I came to visit a friend of mine in January of 1995. And I landed at St. Pete Airport, not Tampa, but St. Pete. And he took me to Clearwater Beach in January. It was 72 degrees. I went home and sold my house. So I've been in St. Petersburg ever since, and been a broker since 1986. And I've got a few years left in me to help people to, be a broker representative for them, help them learn the right way if they're interested in learning about trading, that kind of thing.
Yeah, it's great to hear from you because I mean, I think we talked about this briefly, but we're both in the Tampa Bay area. So you're in St. Pete, I'm in Tampa. So
We're about a half hour away, 35,
yeah,
35 40 minutes.
yeah, not too far at all, and enjoying this nice winter weather, right? And 70s and sunny out.
Where I'm from, they had 6 to 8 inches of snow 2 days ago. So
Man,
it's
I
fun.
bet you
It's fun to
don't
call
miss.
back and it's fun to call back and tease a few old friends.
Yeah, exactly. But I think it's really interesting. You started all this from a postcard. I think like it just speaks to the differences in the time now. Not to try to date you or anything, but I feel if I were to get a postcard in the mail right now or an email about something like this, my red flags would be going off, thinking that this is a scam immediately. So,
I
I mean,
agree.
that whole
Marketing has sure changed. I agree with that. But I think Twitter helps because Twitter lets you answer another Twitter account's questions. And if you can answer their questions, you can build a little rapport that way. Certainly, it helps if the answers or the explanations are factual or truthful in nature. And I think that a lot of people, Brandon, when you're talking about returns on investment, I think people have been burned, with stock market crashes. People have been burned with fixed income rates coming from, I'm older than you are. I remember when CDs used to be 7 and 8% returns. Passbook savings, that's what, they were called when I was a kid. It was a account, they were 4.5% returns. Well, that is nonsense. You can't get 4.5% returns. Although some of the money markets are, squeaking up a bit. We'll talk a little bit about different asset classes, fixed income, a little bit more in the podcast here today.
Yeah, for sure. So, I mean, you've been through a few different market cycles and other things like that. So, I mean, obviously it's an interesting dynamic we got going on right now with, extreme volatility and everything like that. So, has your approach changed to in any way, during this kind of crazy cycle we got going on? And if so, how has it changed?
One interesting thing that people can watch firsthand in the morning that has become very important to moving asset classes meaning, equities or fixed income or, commodities, metals, foreign currencies. One report that comes out monthly is the monthly unemployment report. We'll get the unemployment rate for the month of November. We'll also get how many jobs were created. And the interesting thing is that it seems to be a guess for the jobs, Brandon, because they seem to revise it for the next month or two. They'll go back 1 or 2 months. So maybe the first Friday of January, when they're releasing the December, they might go back and actually, re-advise or give us an updated November jobs created report at that time, the first Friday of January. Happens on the first Friday of every month. Once in a while, they'll defer until the following Friday if there's a holiday or something like that. So like if tomorrow was Veterans Day or Christmas Eve or something like that, it wouldn't be Christmas Eve, the first Friday of the month, but if it was Veterans Day or another holiday, they might defer. But most often, probably 10 out of 12 calendar months, it happens on the first Friday of the month. And people can watch that at 8:30 Eastern or 7:30 Central on whatever business channel they want. They'll all release it real time. And if you've got, I watch Fox Business on Office TV here, and you can immediately see that the S&P 500, the NASDAQ, maybe the price of gold, maybe the price of silver, maybe the value of the US dollar gets affected every month with these government reports. And tomorrow's report is a pretty big one. Another big one is a quarterly, GDP report, and that can affect things too. So in answer to your question, things have changed because more people since the mid 90s have home computers. They have cable TV, so they've got business channels. They actually have more information. So you would think that the more information would help the people, and maybe it can help the people if they're not fully invested, if they've got money on the sidelines, kind of like, in savings, short-term savings, where they're looking to put that work or that money to work for them. Report days can be a good thing, but it can move against them if the reports are seen as dovish, and that might encourage the Federal Reserve to maybe take a little bit of a step back. And that's kind of some of the news that came out of Fed Chairman Powell's mouth the other evening. He said, well, maybe we can, his term was soft landing. Maybe we can get close to a soft landing. And these macro events, these federal reports, government reports, the federal, if they're tightening or loosening short-term interest rates that they lend to banks, things like that, they move markets. And so it becomes a lesson in, trying to preserve your trading capital for everybody. The S&P was down, 18% at its low, and the NASDAQ was down another 10% from that. And a lot of people are hurting. A lot of people's 401ks have dropped. A lot of people's investments have dropped. So I guess that trying to answer your question, the volatility is increased as more and more people have received more, the more current information. But if people are interested, and if they're at work and they can't get it, there might be something that they can put on their phone, an app on their phone that might release that the monthly jobless report in real time, or if they've got an app on their phone for Fox Business or something like that, or CNBC, whomever they want to use, or they can call a friend that's at home or their spouse that's at home or something like that. But 8:30 Eastern, 7:30 Central, and it happens in real time, monthly.
Yeah, and it seems like it's not only, reports like that come out that, drastically kind of swing the markets. It's CPI, just kind of any of these major reports kind of seem to swing the market in some way, shape, or form right now, as more and more people are paying attention to everything that kind of Powell and the Federal Reserve or all these numbers and metrics that kind of come out. So, do you take, any weight into that as a futures trader, or are you more so just kind of, stick to the strategy and just kind of, go by your book that you've, gone to throughout the year?
There's two lessons to be learned from that question that you're asking. And one is that the news is important, but the second lesson is that the market's reaction to the news is more important than the news itself. Okay, so for example, let's say that tomorrow was a Fed update for December. It isn't, but that'll come, I believe, later this month, the mid part of the month. If the Federal Reserve is going to tighten interest rates or raise interest rates again on the amount of the interest rate that they lend to the Federal Reserve partners, it's called the federal funds rate. So if that were to come out tomorrow, okay, and if the consensus is that they're going to raise 50 basis points or 75 basis points, but they end up not raising interest rates, or they only raise 35 basis points, for example. I'm not forecasting that, but I would say that that news that comes out, and it typically comes out around 2 p.m. on a Wednesday. It's a 2-day Fed meeting. On a Wednesday, it comes out around 2 p.m. and he has a little talk about it a half hour later on television. They get broadcast his federal minute that he talks about, his meeting minutes. But if that news comes out, what's more important, Brandon, than that news and that actual 50 basis points, 75 basis points, 25 basis points, is what the stock market, what the bond market, what the US dollar ends up trading shortly after. You'll see it real time again, shortly after 2 o'clock Eastern on federal report days. You'll see immediate reaction. And that actually ends up being, more important than the news itself, where people actually bet wrong. They'll bet wrong ahead of that release, thinking that they know what's going to happen, and we'll end up possibly with a stock market rally. I believe that happened, after the last federal FOMC release. So the stock market rallied a little bit. And so I guess you're asking me about my strategies. I have strategies set up for my clients that are typically, As I mentioned, they're covered calls or short strangles. So we're betting on a range. If we don't want things to go against us too far, but we're betting on a little bit longer term, maybe a 20 or a 40 or a 60-day trading range, and hopefully in line with the trend. In an uptrend or in a downtrend. In an uptrend, you'd be long of futures and short a call. And in a downtrend, you'd be short of futures and short a put against it. And those options help ensure, the equity or the risk capital of the client. It does limit how much you can make on the trade, but with the returns that we're getting, we can add to a winner. If it's working for us, we can add another futures long or futures short as we approach the strike price that we sold or that we bought. If we're doing just an outright call, if you're being outright long a call, I don't tend to do many of those, but if you're long a call, you can, as it approaches the strike price, you want to be looking for a place maybe to take a profit. If it goes deep in the money, that's better. Deep in the money, meaning that call that you own is more profitable. And so in answering your question, it doesn't affect my clients as much. I don't really have clients right now trading equity futures or fixed income futures. So those big movements there, although the reports that I'm talking about, the unemployment reports, the FOMC federal interest rate reports, they have been affecting gold and silver as well. And I think that might have been what put the bottom in silver the last couple of months. A little bit of inkling that we're closer to the top end of them raising interest rates than just midway through. We'll have to wait and see what happens into 2023.
Yeah, exactly. And I think, this strategy is pretty interesting. So, why don't we take it down and take it back to I guess more of a surface level understanding of futures trading and whatnot. So, it seems like, options trading got really popularized during the whole COVID-19 pandemic. A lot of, millennials and people my age and maybe even younger kind of got into it. But, what are some of the benefits that you see of futures trading, and, why is it a strategy that's you've kind of been drawn to?
The main difference between futures and equities that some of your viewers will be possibly trading options on metals companies or options on industrials or on technology companies. The main difference with futures is the leverage involved. And the leverage involved is the good part of futures, but it's the bad part of futures. And it dictates that we meet suitability requirements for our clients, that they meet certain suitability requirements, because using this leveraged vehicle, these leveraged derivatives, there's risk involved. There's risk of loss involved in trading futures and options on futures. All right, now that's set aside already or acknowledged. Answer to your question is that because of the leverage, the returns on invested capital can be many times what somebody might expect from doing a call option on a particular equity or particular stock index or something like that's not a futures contract. Okay, so that's the rationale, or that's the reason that I sit in a futures chair rather than a stock chair. That the quick, easy example is if you talk about one contract of silver, and we can, I guess, just kind of maybe use that as a quick, easy example. At $22, a contract of silver, it's 5,000 ounces. That's $110,000. So one of your listeners has to invest $110,000 if they could buy that at the futures price, which they can't. They can with a futures contract, but you can't go to your coin dealer and say, I want 5,000 ounces of silver at $22. Well, today, Brandon, it's $23. It went up $1 today. All right, but let's say at the start of the day, $22 an ounce times 5,000 ounces, it's $110,000 cash. Okay. My futures clients can trade one contract or two contracts or five contracts or whatever they've got, suitable, whatever they're suitable to trade for $9,350 a contract. So you can see the difference, $110,000 of cash total contract value, or under $10,000 of margin deposit. So, and the options are indicative of that leverage as well. So if you buy a futures contract and you sell a call that's $2 out of the money, you might end up getting 50 cents, depending on how much time you're selling, or 60 cents. Well, in futures, because it's a 5,000 ounce contract, okay, every penny is worth $50. Well, if you collect 60 cents, you collect $3,000. Okay, well, $3,000 is 33% of the contract value of the margin requirement. Because the margin requirement's $9,300 and you collect $3,000. Well, if you buy futures and you sell a call $2 out of the money and you collect 60 cents, you're $3,000 ahead, or 33% ahead, not counting fees, trading fees, and NFA regulatory fees, which are very minimal. So that's the big difference, sitting in a futures chair rather than having your viewers go to the coin shop, pluck down $110,000. And the way the return works is that if the margin is $9,300, because it's a 5,000 ounce contract, every dollar that silver moves in your favor, higher in this case, is $5,000. So the easy arithmetic is a $2 move doubles your money, doubles your return on investment. 100% return every $2 up at the current margin rate. Well, the same $2 move, if you had the 5,000 cash physical ounces, that same $10,000 move would be a 10% return on 110,000. It'd be a little less than 10%, maybe 8.5% return. So there's the beauty in futures. That's the good side. The bad side is futures, every time it moves either up or down, one side wins and one side loses. So the person that's benefiting, he's benefiting directly from the other side of the contract trade. There's a buyer and a seller for each contract. And the benefactor, if the price of silver moves higher today, the person that's long gets paid from the person that's short at the end of every day. The money transfers from the losing side to the winning side. So you don't have to wait to sell your futures contract like you would have to sell your 5,000 ounces or a portion of the 5,000 ounces to realize return on equity, so to speak. In futures, if you make that $2, you make that $10,000, okay, $5,000 per dollar because it's 5,000 ounces. All right, your open trade equity is $10,000 if it moved $2 in your favor, and it's moved $4 in long's favors since the September. So it's up nicely, and the return on investment, if you want to use the word, gets supercharged if you're on the right side of the trade with a futures with a leverage derivative. But if you're on the wrong side, it's the same amount that you're losing. The only thing is your broker can use ways to protect you from losing, by using stop loss orders, either if you're long or if you're short, or you can get an option to protect yourself. If you're short the futures, you can buy a call that'll protect yourself in case the futures start to rally, those kind of things. But that's the rationale, or that's the reason I'm in a futures chair rather than I guess in this example, rather than in a physical metals chair, selling people 5,000 ounces of physical silver. Now, those guys are doing great because the premiums have gone higher, but much to the chagrin of the investor that has to pay that, that premium, those higher premiums. But that's the rationale that why futures, in my opinion, can really help a speculator with risk capital. I want to emphasize risk capital, meaning money that you can afford if it goes against you, because of the leverage involved. The returns can be very exciting at times.
Yeah, and I mean that's awesome, and I definitely see the positives and the potential for the gain there. But another aspect of you that I think is really interesting is like it's not only the futures contracts of potential equities that is kind of interesting and unique. It's also the commodities aspect of it, and it seems like you really analyze the commodities, especially silver. So how did you kind of get into that realm? And we've seen kind of a little bit of run from the treasuries kind of running up. So, why do you think that is?
Well, the treasury's running up. It's like a teeter totter. So we kind of bottomed out in treasury bonds earlier this year. I think I've got it written down here. Let's see. The low was made at the 118 level, and we're trading today at 129. Well, so that means that the 30-year treasury bond bottomed out at the lows when the interest rates were probably 3% or so. And they rallied up to like 4.25, 4.35% in the 30-year treasury bond. Well, now as the price rallies, it's like a teeter totter with the interest rate on one side and the price on the other. As the interest rate goes up, the price of the bond goes down. That's an easy way to visualize it in your head. And the price of the treasury actually rebounded a little bit. It's off that the totter from the teeter totter is off the ground a little bit because we've come back and rates have dropped. Well, the rates have dropped maybe. Once again, the Fed doesn't set the rate of a treasury bond or a treasury note. They can set the price of the federal funds rate that their Federal Reserve member banks borrow from the Fed. All right. The market sets the interest rate on the treasury bonds and on the treasury notes, the 10-year, the 5-year, the 30-year, if you will. So you're making a nice connection in that gold and silver don't really offer a return like an interest rate return on your savings or on a CD, or somebody might invest in a fixed income or in an equity product that generates what's known as a dividend. They share part of their profits with their shareholders, their owners. And one interesting thing is that I've got this company in my portfolio, First Majestic Silver, recently, probably in the last 2 quarters, started paying a little itty bitty dividend. And maybe it'll go up as they start, generating more profits as the price of silver and the price of gold go higher. But as the rate of interest rate starts to increase, the holding cost for holding an ounce of gold or many ounces of silver, it kind of goes against somebody that might be saying, well, I'm holding this metal, not a rock. People call it a rock, but I'm holding this metal and I'm not generating a return. So my answer to that is, well, hold some of the metal if you want to for a chance at a capital gain, which is better than a dividend from a point of income tax. What you have to pay better depending on people's tax brackets or tax situations, but hold some. Don't hold 100% equities and don't hold 100% gold or 100% silver. Have a mix, whatever you feel comfortable in, because it's my opinion that the potential for a capital gain in silver from $17, $18, $16, gold was $1,600 and some dollars here in the last month, that the potential for a capital gain is pretty good if, the people that are in charge, the government people that are in charge, the Federal Reserve, things like that, the Congress, if they really mess things up when we owe $31 trillion. So that's one of the macros that I, try and keep an eye on in terms of what our deficit is, what Congress is doing to maintain that deficit, or what has been, the last 12 years increase the deficit. And I think every $1 trillion that the deficit goes up adds to the potential that silver can go up. Silver as a halfway thought of monetary metal, and half of it is thought of as an industrial metal. So, and coins are somewhere in between. People are holding coins maybe to have a capital gain, but maybe because the industry side is getting bigger and bigger, and the monetary side might get bigger and bigger if the dollar starts having some weakness. So several of those things, the value of the dollar, what Congress is doing, what the Federal Reserve is doing, what the government is doing, and what the marketplace is doing. And that kind of helps me try and analyze things, quick and dirty on a daily basis, if you will, and decide if it's time to add or time to pare back a little bit. I think it's a good time to add.
Yeah, and it always seems like, during the downswings, it is, a pretty good time to add. But, I'm curious how you view this cycle because, you talked about, the deficit obviously rapidly increasing. We had a lot of QE the past, couple years or so, with 2020, the COVID pandemic, a lot of money printing, what have you. But how does this kind of differ from other, cycles? I mean, we've seen, you've seen 2000, the dot-com boom, 2008, and a few others. So, how are you kind of viewing this one compared to some of the others?
It depends on what metric you want to choose to analyze, Brandon. And I guess that would, I would go back to the asset class. If your asset class that you favor is equities, well, you know that the Dow Jones can be 35, 36,000, but you also know the Dow Jones can be 900 or 1,000. Not in, in recent history, but things can, there can be some grief involved. If your asset class that you're looking at is high tech stocks, we've seen the NASDAQ drop almost percent from the highs to the recent lows. It's bounced off that a little bit. But some of the companies that make up the NASDAQ 100 index, I'm not licensed to talk about stocks, but so I'll just speak in generalities. Some of those stocks that make up that index are off 40 or 45% or 50% from their highs. All right. Now, we've been visiting a little bit about one asset class that I have an affinity for, and that is metals. Silver is off its highs by more than 50%. Okay. At the same time that I think the government has things kind of mixed up a little bit. And the high in silver twice has been $49 to $50. And half of that is 25. And I'm on record on Twitter saying that silver is a buy under $25, a steal under $20. A very good buy under $20, a Kmart green light, blue light special, if you will. So depending on how you want to analyze, what asset class you want to analyze, can determine, how you want to view things. If you want to view things on a technical basis, which means, price action, you could simply say that some of those NASDAQ stocks are in the same place that silver is in. Well, maybe, from a technical side, you might make that, that equivalent statement, but I don't see it the same. I see it the same that silver has a real promising future from the technical side in EVs that some governments are mandating, including ours, that people have to have EVs starting in 2030 or 2035. Also, solar panels have got a worldwide bid underneath them, it seems like, because of the obvious. People can make their utility bills retract a little bit in Sunbelt areas if they want to use solar. And solar cells can use some parts of silver. All electronics, from the phone you have probably on your desk to the TV that you might have in your den, use silver solder, things like that. So I think silver's got a very promising future from a price that doesn't make sense to me when a very prominent mining chief executive says it comes out of the ground at 7 ounces of silver for each ounce of gold. And we've been trading 80 to 90 on a gold divided by silver basis. People call it a gold silver ratio. That's exactly what it is. You divide the price of gold by the price of silver, and it's been 90. It's down to 80 or around 80. I didn't look today, but it's down to around 80 because silver has, since September, actually outperformed the price of gold on a percentage return basis. So people get to do, each investor, each viewer gets to do their own analysis. I would just offer, I'm kind of here to answer some questions and to maybe prompt a few people to consider if there's suitability, requirements of net worth and income would allow them to maybe look at putting a portion of their investable assets in a leveraged derivative account. It can work for them nicely, or I certainly, understand when people say, no, I'm real happy with my tech stocks. I understand that as well.
Yeah, so I mean, I guess the diversification, obviously, during this time could be something that's advantageous, and especially when we've kind of seen the demise of tech recently. We've seen tech stocks down 80 to 90%, some crazy numbers in the past year, just kind of falling apart. So have you got, I guess, kind of seen more of a demand and more of, I guess, a hunger for this kind of information that you're talking about right now?
I think the big money, to be honest with you, where the big flows that move market pricing is, price levels that move price levels, the big money are institutions. And those institutions are people that trade life insurance or pension fund money, things like that. And I think that they have got investable models that they take their total assets under management (AUM) and then they allocate to different sectors. And there's a gentleman, I don't want to speak for him, but I will mention his name. His name is Rick Rule. He's a very wise, very experienced, retired gentleman now, I believe, that is starting his own Rick Rule channel. And his opinion is, and I would call his opinion his expert opinion, almost to the point of being factual, that rather than just an opinion, his opinion is that the assets under management allocated to the metals are historically very low. And he thinks that if they would just get back to the norm, that we would see a bounce because of more big money flows coming into the from assets under management into the space meaning the gold space or the silver space. I don't know if it includes platinum and palladium. I'm not quite sure, but I would certainly think that, not speaking for Mr. Rule, but certainly think that he's thinking that assets under management can increase in the precious metals, which I view it as gold and silver space. They can increase in the next bull market. And I think we're starting a next bull market. I think it's actually started. And I assume that we will see money chasing performance. And as money chases performance, I think that we could see the silver chart doing better over the next several months.
Yeah, so I mean, it's interesting. So you called it a bull market. So do you mean like a bull market as far as the precious metals go, like gold and silver, or do you mean just a bull market kind of in general and as overall like the overall economy?
Yeah, I want to be careful, I guess, because a bull market doesn't mean every asset class. Okay, I think that there's a double bottom on the bond chart. If people want to look at that, the bond chart I refer to is the 30-year T bond. We have a 10-year Treasury note contract as well. But you can, what your viewers have a passion for or have a experience in, they can look at their own, field of interest. I thought we were, talking a little bit about metals here, and that's kind of what I was trying to describe. I think that the low in silver is September 1st, and I've been on record how I try to, kind of analyze or impart my risk reward calculation to folks is such that I use a risk reward analysis. How much do I see near term downside versus near term upside? And I hit it right on the head here in the last 3 months or so. I published tweets on Twitter saying we've got $1.50 downside, we've got $3 to $4 upside. Well, we're more than $4 off the bottom today at today's high. So that's a home run call. I'm not patting my back, my hand on my back. I get lucky with this call, and I've been wrong and wrong as well. But I'm quick to be honest and open when I'm on the wrong side. But I think that looking forward in specifically silver and gold, I think gold's got a high coming, and a high in gold is about 2,079. I think we can get through that, and if we get through that, we can see maybe in the next year or two, $2,500 gold. That's my longer term forecast. That's not my short term forecast. In silver, it's a little bit easier because we're so low. Gold is only, $300 off the high. Silver is, it's more than half still below the high. Half is 25. 25 is half of 50. And we're $23 today, just a little under 23 probably as we're talking. I don't have it on now. I've got my computer on in front of me. But so from $23, that's been a big level for me. That was my second resistance level. My first one was 21, and then I said 23, and we're going to be there. I don't know if we're going to close above 23 tomorrow, Brandon, but if we close above 23 at the end of December, I look forward to seeing 25 plus shortly, maybe first quarter of 2023 for a short-term call. Long-term call, silver has a very bright future, in my opinion. And there are nice strategies to trade covered calls on silver for the next several quarters, in my opinion.
Yeah, and so it's interesting too because you seem very intrigued by the silver markets, but the way you're describing it, it's only a dollar or two kind of change here or there. It's not the extreme volatility that a lot of I guess newer traders have kind of been accustomed to with this massive amounts of volatility that's kind of come into the market. So as your view kind of always been hit those singles, those doubles, and what have you, and kind of keep stacking it, or do
Well, go
are
ahead.
there the ways you can hit like home runs in some of these
Well, I
futures?
think that if I asked you, Brandon, what is a home run return annualized? Let me just ask you that.
You're putting me on the spot here.
No,
I
no,
don't
I'm just asking you, I mean, what would you consider to be a home run? Is a home
well,
run 20% annualized?
yeah, probably. I mean, like so I'm a little different, I guess, than maybe maybe some of my listeners because
Okay.
I actually got in the market because I've started this early on with a friend who kind of just got into investing around the start of 2020. So he was kind of complaining that a couple of his stocks weren't doing that well and they were only up 20% at the time.
Okay.
So for me, I was like, well, I kind of got started in this where I was expecting, I think I started investing in 2016 or so. So it was like, still a good time, but yeah, S&P 500 was up like 7 to 12% on average, during that time period when I first started. So, 20% to me sounds like a home run, but it's also, I also got to ask the question, what's it relative to? If you're getting a 20% return and the rest of the market is up, 50%, then no, I wouldn't say it's really a home run hit. But if it's a 20% return and the rest of the market is, 11% return or
Sure.
12% return,
No,
then
that's very fair. I guess um, I would say my pencil is pretty sharp, is one way to say it. I would say that if your viewers of this uh, particular podcast that we're doing today, if every one of your viewers was up 20% year to date, I think people would be ecstatic. Probably not many are because I'm going to guess, I don't know your podcast audience, but I'm going to guess that the majority of people are probably marked to a model, an investment model that some people like to say 60-40, including their 401ks or their IRAs. And 60-40 might 60% equities, 40% fixed income. And your listeners, maybe you've got a pretty sophisticated audience. Maybe they have 10 or 20% allocated to precious metals because you talk about that. We have not talked about crypto, and I don't really want to talk about crypto, but I know that on some of your Twitter Spaces events, you have a high number of folks that are well versed in cryptocurrencies. Okay, and that has been a big asset class for the last 5 years, and it may be continue to be a big asset class for the next 5 years. But I didn't come on today to talk about crypto. But my point in mentioning it is that maybe some of your sophisticated viewership audience, if you will, has an allocation to some different types of asset classes than what I'm talking about. Okay. And I would say 20%. That's the reason I ask, is 20% a home run? I don't think in futures 20% is a home, but I think that more than 20% in futures can be classified as a home run. This year, I think if futures people were up 20%, I think they'd be pretty happy. So the leverage helps, but understand that you're taking more risk with a futures contract. So my risk reward mentioned moments ago, I said I brought up $1.50 downside in silver. Well, that's $7,500 is $1.50 downside. Okay, $7,500 on a $9,000 margin is a pretty big loss. Okay, but we're at $23, so it turned out to work out in my favor. And if I've got clients in silver, which I do, that's all I'm going to say about it. My folks are pretty happy today, and we'll see what happens tomorrow. We didn't quite make it to a positive over 22. We did last night at 5 o'clock. How the futures work is they start on a Sunday night at 6 o'clock, and they trade until the following day, Monday, at 5 o'clock Eastern time. Then they break for an hour. Then they'll start Tuesday's trade will start at 6 o'clock Monday evening. Well, so today was December 1st. It would have been nice to close above $22 yesterday to make it the close for November, but we're going to get it on a weekly chart. It's going to show up on the weekly chart. So it's there. It's just that some people, fewer people might look at a weekly than at a daily chart. That's the only difference.
I gotcha. Well, that's all great and well. So we do, like you mentioned, it has just turned December 1st. We got one last month of 2022 here, and then we kind of roll into 2023 with a lot of uncertainties in the market and other things like that. So you've already kind of mentioned it a little bit briefly here, but what is your, I guess, overall outlook for 2023? You mentioned it. You kind of think that the precious metals might be amongst or pretty close to another bull market. So yeah, I guess what's the overall outlook for next year, and how are you gonna keep positioning yourself?
Brandon, before I try and answer that question, could I cover one quick part of futures that some understand and some kind of misunderstand? Would that be okay?
Yeah, please do.
It's the delivery process. Okay. Now, when I say deliveries, people have all sorts of opinions. Some are truthful, factual, some are just opinions and they don't really know what they're talking about. Delivery means we trade some things that are deliverable and some things that aren't. For example, live cattle contract is deliverable, meaning you can stand and get live cattle if you're in that business, if you're a packing plant, if you're a cattle rancher. But feeder cattle contract isn't. Feeder cattle is settled in cash. Okay, crude oil is deliverable, but it's a 42,000, it's a 1,000 barrel, 42 gallons per barrel. It's a 42,000 gallon contract, 1,000 barrels. And not one person I know of is suitable to take delivery of crude oil. Okay, so you have to know what you're doing, when you talk about physically settled or deliverable contracts. Gold and silver are deliverable. And I just want to bring it up because people on Twitter for the last several years, there's a small faction of folks on Twitter that says delivery never happens. It's a scam. It's a bunch of nonsense. It never happens. Yes, they call it the Crimex exchange instead of the COMEX exchange. Well, the COMEX exchange is just the exchange where trading happens. The COMEX facilitates a short and a long to do business. Okay, and at the end of every month, for the example, the end of November just happened, and first notice day for delivery for the December contracts was 2 days ago. Okay, so today's gone. So today's the second day in delivery, December 1st. So the first notice day was November 30th. All right, so people can start delivering. And a bunch did. A bunch of people delivered silver contracts. More people delivered gold contracts. And the people that are on Twitter, they seem to think that, well, there's no silver there being delivered. Well, they're wrong. All right. So I wanted to make sure that I, brought it to your audience's attention that the people that are short the silver to the delivery period are people that own the silver. They own the physical silver. They entered a short contract to deliver their silver, in essence, to take a profit or to unwind their 5,000 ounces, their 1,000 ounce bars of silver to a speculator that wants delivery. And why does somebody want delivery? Well, there's one man on Twitter, and I've got to hand it to this guy. He's a terrific ingenuity, terrific foresight and planning. He buys the bars, Brandon. He invested in some saws or some laser cutters recently. He cuts up the bars and sells them to the retail people on Twitter and makes a profit. It's the neatest thing that you can imagine, that somebody with a little bit of foresight and spunk is using cash to take delivery of silver, cutting up the silver and making a profit on the silver, not to compete necessarily with the big online dealers, but to offer chunks of silver or little knickknacks if he melts them down and he makes some shapes. And he's doing it. He's making, I hope he's making a living. I hope he's making a good living. And I give him kudos every once in a while on his posts on Twitter. I hope you make a ton, basically, is what I'm saying. So I wanted to cover the delivery. just as in passing, so your people can know that if they don't understand it, I'm here to help. I'll answer questions on a direct message or on a Twitter post or something like that to the best of my ability. Delivery happens every single month. There are main months where on the COMEX exchange where the open interest higher, and they don't always coincide. Gold and silver, those particular months aren't always the same, but they are in December. There's a common high number of traders that trade in the December contract for both gold and silver. So the deliveries are underway, and they'll go till probably the 27th or 28th of December. I've got it on a calendar. I didn't write it down for this broadcast, but delivery will happen for the most of the month of December. Please understand, when there's holidays, those holidays stop delivery. It'll be the day after, the day before. The short gets to decide. The man that owns the silver gets to decide when he trades silver for the long's cash. The long post cash, the short post silver, and they just swap through their futures commission merchants. And it takes 2 days to settle the futures, and then the next day they physically exchange the title to the silver or the gold for cash between the two participants, between the long and the short. So don't take delivery of crude oil ever, folks. If you're listening, never, never, never. It's each swimming pool, if you've got one in the back of your yard, might be 12,000 gallons. I already mentioned it's a 42,000 gallon contract. You're going to have a lot of folks after you if you want to store crude oil in your backyard. So please use a reputable broker that won't get you involved in delivery on crude oil or gasoline or natural gas or something like that. Okay, back to what your question is, I guess, and we can kind of wrap up a little bit. I think that energy can do a little bit better. I think that as energy goes a little higher, it causes the cost of production at some of these mines to go higher. And I don't foresee increases in cost of production being bearish for gold, the price of an ounce of gold or the price of an ounce of silver. They've got to make money, otherwise they stop producing, Brandon. If they stop producing, the supply dwindles, and the demand, I already mentioned the demand, maybe not so much for gold, although there's central bank demand for gold, there's investor demand for gold, but there's industrial demand for silver. And I think that's going to heat up. I think that that'll increase on a percentage basis through the years, over the next 3 to 5 to 10 years. And, coinciding with more EVs being produced, more color TVs, more Apple and Google phones, that kind of thing. And so I think that there's a bright future that, if people are so inclined to buy dips in buy lower prices when they happen in gold, lower prices in silver. Natural gas got a little bit ahead of itself this summer. It traded almost $10. Then it traded lower. It made a low in made a low in October of $5.64, almost a 50% natural gas. And you and I, we don't have winter where we live in Florida, Brandon, but my friends back home have winter, and they've got their furnaces on today. And I think natural gas can do a little bit better, especially when you look at how much natural gas costs in other countries around the world. So I think the dollar seems like it's topped just under 115 on the dollar index. As a macro to maybe for your listeners to take a look at, the US dollar is a worldwide currency. It's not just a US dollar. It's a worldwide currency that carries a lot of weight in the world. If it starts to carry less weight in the world, the value of the dollar could, start to recede a little bit. The high was just under 115, and it's trading, 105-ish, something like that today. And it's had a little bit of a decline in the last, 8 weeks or so, or 10 weeks. And as the price of the dollar comes down, I think that that's another macro event that puts support back, for your listeners to start looking at maybe some equities, because the equities that produce product that might sell some of it domestically, but they might export some of it. And that might be a gallon of gasoline, or some cattle, or some soybeans, or some wheat, something like that. Those commodities can actually benefit if the price of the value of the US dollar recedes a little. Under 104, the dollar looks to me like it's topped. Under 100 on the dollar index, some people call it the DXY, if you want to follow it. under 100, I think commodities get a little bit of a boost.
Well, that's awesome stuff. And that's a great outlook. And I really appreciate your time. I appreciate you coming on the Tuesday Night Spaces and sharing your wisdom with us. So, Jim, thank you so much. Why don't you tell people where they can find you and what you got going on?
You can reach me on Twitter. My name or my handle is shown in the video under me there at Jim Suncom1. You can reach me there. You can send me a direct message. You can follow me. I've had a lot of posted tweets that go over examples, that talk about leverage, that talk about risk, those kind of things. I will try and answer people's questions. I don't feel comfortable because I don't have the right kind of license to talk about stocks or mutual funds or ETFs, exchange traded funds, or limited partnerships. And but I can certainly opine on futures contracts, on leverage, on risk reward, those kind of things. And I've got room for a few more people. If a few more people wanted to ask about, having a futures account, I've got room for that. And I am going to trade for a few more years. I'm not 100 years old, but I'm getting up there. But I've got, a few more years in my repertoire, I guess, for trading. I'm good at it. I certainly understand. I've lost money for folks. I've made money for folks, and I know the difference. And there's ample time. The decisions to make are what you decide to trade, when you're going to trade it, and then which way. Those are the three big variables: what, when, and which way. And then you got to add timing in there. That kind of adds to the when. But the obvious answer is, when you're in an uptrend, you want to be trying buying dips and be long. When you're in a downtrend, you want to be selling rallies or try and be short. That's kind of it in a nutshell.
Yep. So everybody give him a follow on Twitter at Jim Suncom1 on Twitter, and I'll put that in the show notes. Jim, thank you so much. I hope you stay warm, and maybe we'll grab a coffee or a beer sometime.
That'd be great, Brandon. We're not that far apart. It'd be great to do that, and it'd be fun to do another podcast in the future if your audience would like that.
Yeah, for sure. You'll definitely welcome back on. So, Jim, thank you so much.
Thank you, sir, for your time.